Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into BILL Holdings, Inc. ticker symbol BILL. The mission today is, well, it's crucial. We need to fully grasp the investment thesis for BILL, especially amid this challenging market. The company is in a massive strategic pivot, and we need to understand exactly where they are placing their bets to drive profitable growth, particularly as those tailwinds from high interest rates start to disappear.
That's absolutely the core challenge we're analyzing for you, and it's a high-stakes pivot. The thesis is really this. BILL is betting its pivot to profitability, and they're achieving a pretty robust 17% non-GAAP operating margin. Alongside that, they have this high-growth Embed 2.0 strategy, which is, led by their agentic AI, and the hope is that all this will secure their goal of 20% or greater core revenue growth in fiscal year 26.
And that would justify its valuation.
Exactly. Justify its valuation against these persistent macro headwinds and, as you said, that decreasing float revenue.
Okay, that thesis gives us a lot of critical data points right up front. That 17% profitability figure really jumps out. For our listener, when we talk about a non-GAAP operating margin like that, what are we really saying about the operational health of the business?
It's a key metric, especially for software companies. Non-GAAP metrics, they basically strip out non-cash expenses. Things like stock-based compensation, some restructuring costs, to show how well the company is managing its day-to-day operations, its core spending.
So it's a cleaner look at profitability.
It is, and achieving a 17% margin, which translates to $68 million in operating income in Q1, that's a powerful signal. It means the efficiency efforts they've been pushing are flowing directly to the bottom line. It's a real commitment to profitable growth, moving past that old, growth at any cost mindset.
Right, and that at $68 million, that was $10 million above their own high-end guidance. That suggests Q1 FY26 was strong across the board. Can you give us the full financial snapshot?
Yeah, Q1 showed some really significant momentum, particularly around expense discipline. Total revenue came in at $395.7 million.
Which is pretty solid growth.
It's solid. That's 10.4% year over year. But for investors, the focus really has to be on core revenue.
The subscriptions and transaction fees.
Exactly. The stable, recurring stuff. That figure was $358 million. Which is an impressive 90.5% of their total revenue. And it hit the very top end of their guidance range.
The fact that over 90% of revenue is coming from core operations, that screams stability, especially in this kind of volatile economy. Now, if we look inside that core revenue bucket, which specific product lines are really driving the growth?
Okay, so if we break down the segments, the real standout performer was Bill Spend and Expense. You'll see it called BSE.
That's their card and expense management tool.
Right. Its revenue growth was the fastest of any segment in core revenue, up 18.6% year over year. That's about $157 million. And the fundamental driver here was just robust usage. Card payment volume itself increased 21% year over year, and that was largely fueled by strength in retail spend among their clients.
So that strong performance in BSE, it confirms that direct customer engagement is working. But like we said at the top, direct sales can be incredibly expensive. It's the enemy of that 17% margin, which brings us, I think, very neatly to their big strategic response, the Embed 2.0 strategy. This feels like their major lever for long-term efficient growth.
Precisely. They are making a very concerted effort to shift away from just relying on high-cost direct sales. Embed 2.0 is all about leveraging BILL's scale, its data, and its payment capabilities to efficiently expand distribution into these massive existing partner ecosystems.
So instead of chasing every small business one by one,
they're putting their platform right where SMBs already live, inside their accounting and payroll systems.
That's a fundamentally different model. And we saw 3 huge partnership announcements in Q1 that seem critical to this. Who did they bring into the tent?
They landed some extremely significant partners. We're talking NetSuite, Paychex, and Acumatica.
I mean, those are giants.
They are, and the scale here is what really matters. These 3 partners, together, they serve nearly 1 million small to mid-sized businesses.
1 million businesses.
And if you tally up the potential market opportunity just by putting BILL's functionality inside these systems, it represents an estimated $1 trillion in annual payment volume.
That $1 trillion figure it's staggering. It absolutely catches your attention. But, as a skeptic, I have to ask, $1 trillion in potential volume is one thing. How quickly does that turn into actual revenue?
That's a fair challenge. The revenue won't flow instantly, but the integration is designed for immediate value add and, quick stickiness. Look at the NetSuite partnership. It's not just some API link. It embeds BILL's payment automation directly into NetSuite's own system.
So it feels native.
It feels native. The value is immediate. Shared customers can speed up their AP processes, boost efficiency, and cut down the risk of manual error, all without ever leaving NetSuite. It's frictionless. And that's valuable today.
Okay, so if efficiency and system stickiness are the keywords, that brings us to the future of automation. AI BILL has explicitly committed to achieving, and I'm quoting here, truly touchless B2B transactions. What are they doing in the AI space that's actually different?
Their big innovation is the launch of BILL AI, which happened back in October 2025. And it focuses on what they call agentic AI.
Agentic AI. Okay, so what does that actually do? I mean, in practical terms for a business owner.
Right. So instead of just smart chatbots, they're introducing these specialized AI agents, and they're designed to autonomously execute specific, traditionally tedious back office tasks.
Give us an example, because anyone who's run a small business knows the real administrative torture that exists in this process.
Absolutely. The two main initial targets are pain points everyone hates: autonomously collecting and validating W-9 forms, and automatically reconciling receipts. I mean, just think about the time saved by having a digital agent chase, verify, and file compliance docs like W-9s without any human intervention. That feature alone, if it works flawlessly, delivers immediate ROI.
That sounds fantastic. But why, Bill? Every fintech is talking about AI. What gives them a proprietary edge here?
This is where their sheer scale creates a huge moat. Their capability isn't built on, some generic public model. It's built on BILL's massive proprietary data set. They've processed over $1 trillion in cumulative transaction volume, billions of documents.
And that data is unique to them.
It's unique. That deep contextual financial history lets their AI be far more accurate, especially with all the weird variations you see in invoices and receipts in the real world. A general model just can't compete with that.
Right. Now, beyond just automating payables, BILL is clearly trying to become the sort of financial operating system for the SMB. Tell us about the expansion into broader financial services. I'm thinking of their treasury capability.
That's where the BILL Cash account comes in. It launched in Q1, and it's positioned as a high-yield, fully integrated operating bank account. Management sees this as the foundational first step. The goal is simple: offer a single platform where businesses can manage cash flow, enable faster payments, and earn interest on idle funds.
It makes the platform stickier.
Incredibly sticky. We even heard a customer quote that summed it up perfectly. They said, "Now I have a one-stop shop to manage payables, card spend, and cash all in one place."
That integration is compelling. And on the topic of faster payments, how is their emerging portfolio doing? Those high-velocity options.
Extremely well. Their ad valorem portfolio, which includes instant payments and working capital solutions like invoice financing, is seeing really significant uptake. Cumulative payment volume in that segment has now reached about $10 billion.
Wow, $10 billion.
Yeah, which indicates users are quickly adopting and trusting BILL for quick access to funds, which are generally higher margin products for the company.
Okay, now we have to address the big counterweight to all this growth: float revenue. For the last couple of years, high interest rates made float a windfall for companies like BILL. But those rates are falling. What's the damage report?
The headwind is material, and it's accelerating. Float revenue fell 13.3% year over year in Q1, dropping to $37.7 million.
And that's just a direct result of falling rates.
It is. The annualized yield on funds they held for customers dropped from over 5%. Down to about 4.1%.
So what are they guiding for the full fiscal year 2026?
They're managing expectations down, and they're doing it aggressively. Float revenue is guided significantly lower for the full year, projected at just $134 million.
So that confirms it. The reliance on interest income is ending.
It's over. The thesis now hinges entirely on core revenue growth accelerating to that 20% plus target to absorb this shrinking flow. They can't afford to miss on their core growth.
That pressure makes the balance sheet strength even more critical. How is BILL positioned financially to execute this pivot?
Their liquidity is exceptionally strong, which gives them a really significant cushion. They're reporting about $1.1 billion in cash and another $1.2 billion in short-term investments.
And a debt situation.
The debt structure is very favorable. They have $1.4 billion of 0% convertible senior notes that aren't due until 2030. 30.
0%.
0%. So they have long-term flexibility without the burden of high interest payments, which is essential when you're funding this kind of strategic pivot.
And they're also using that balance sheet strength to return capital to shareholders, which signals some confidence.
Exactly. Management has a $300 million authorized share repurchase program, and they were aggressive in Q1, buying back and retiring almost 1.7 million shares for about $82 million.
That is a pretty clear message.
It does. It says management believes the stock is undervalued relative to the profitability and growth they're starting to generate.
Okay, let's pull this all together for a final verdict. Management is targeting that 16 to 17% non-GAAP operating margin for the full year. They also mentioned the Rule of 40. For the listener, why is that so critical here?
The Rule of 40 is, well, it's key for assessing the health of a mature, growing software company. It dictates that your revenue growth rate plus your profit margin should equal 40% or higher.
So with a 17% margin.
Right. If they're targeting 17% profitability, they now only need to achieve 23% core revenue growth to hit that Rule of 40 target. And remember, they're guiding for 20% or greater. This efficiency pivot has shifted the entire financial calculation.
But that focus on margin and efficiency came at a cost. They executed a restructuring in October 2025, which included a 6% reduction in force, or RIF. Doing a RIF right after posting stellar profitability, that might look concerning. Is management signaling these gains aren't sustainable, or is this a bigger structural shift?
It's the latter. It's a definitive signal of a structural shift. The 6% RIF was designed to improve efficiencies and align their headcount with these new margin-focused goals, especially leveraging AI internally. I mean, it cost them about $9 million in Q1, but the long-term benefit is a leaner organization that can sustain those high margins. They're trading expensive overhead for automated distribution.
That makes sense. But there are always external risks. What are the three most pressing investment risks we need to monitor outside of the float revenue?
First and foremost is just macroeconomic volatility. It's the primary external risk. Continued uncertainty constrains total payment volume, or TPV, per customer. If SMBs tighten their belts, BILL feels it immediately.
Okay, that's number one. What's two?
Second, there is credit risk exposure. As they expand services, especially through things like their acquired card receivables, which are collateralized at about $475 million, and invoice financing, they take on more risk. The allowance for losses is stable for now, but any downturn could challenge that.
And
Finally, regulatory risks are just increasing rapidly. New legislation like the EU's AI Act that came into effect in August 24 introduces new complexities. And they still have to navigate all the existing rules like OFAC and anti-money laundering.
So, synthesizing this for the listener, BILL presents a compelling thesis. It's driven by this dual strategy of high-growth partnerships and cutting-edge AI, all while sticking to aggressive margin targets. But the execution has to be flawless. They have to navigate that shrinking float revenue and the external macro uncertainty that continues to slow down SMB spending.
Precisely. The challenge for you as the investor is to track that execution and consider this as they deliberately shift upmarket, integrating with larger, more stable customers. Think about how that might structurally change BILL's Rule of 40 metric over the next few years. That focus on quality partnership volume rather than just chasing every small customer might redefine the entire valuation story.
Risk defined, portfolio protected.